안녕하십니까. 오늘도 아침 일찍 이렇게 많이 나와주셔서 대단히 감사합니다. 그러면 곧 회의를 시작하도록 하겠습니다. Well, good morning, ladies and gentlemen. Thank you very much for joining us this morning for a very, very special lecture by Professor Martin Feldstein. I'm sure all of you know him well, not only because he was here a number of times before, around this time last year and the year before as well, but because he is one of the most distinguished, renowned economists of our time. I personally believe that he is the most respected economist among his fellow economists, which is very, very important. And more importantly, we have been friends for many decades. We've been keeping our friendship since the 1980s. We run to each other in various international conferences and meetings, including Trilateral Commission meeting, which both of us are members. Professor Feldstein still is the George F. Baker Professor of Economics at Harvard University. He still teaches there. And he is President Emeritus of National Bureau of Economic Research, which you know again very well. It's the most prestigious the research organization, nonprofit organization in the world, actually. He served various U.S. government, the U.S. administrations, Bush and Obama, but most importantly, he was chairman of Council of Economic Advisors and chief economic advisor to President Reagan in the 80s, and he is very active still, as you can see. Write columns in Wall Street Journal and various international media. In fact, Marty, I read your piece, a very recent piece in Project Syndicate on Trump's trade policy and the tariff on aluminum and the steel. I'm sure he will address on this issue as well. And also he very actively advised various governments, not only U.S. government, but the governments all over the world. And also he sits on various boards of public corporations. He certainly is not a really armchair economist. He is very active. In fact, this time I understand, again, as last year, Citadel, one of the leading investor in the global financial markets, and very, very successful and high-performing the investment organization. And he traveled around this time of the year for the Citadel, I understand this. He just arrived late last night That's why we begin a little late, and I appreciate very much the Professor Feldstein joining us early this morning. He has very, very busy schedule as usual. And particularly last year, I remember he arrived here at 5:30 in the morning, and then he took shower, and then he came to our forum, and then he has to rush back to China. But in any case, we're very, very fortunate to have Professor Martin Feldstein at this very moment when most Koreans are very much interested in the current state of particularly U.S. economy and President Trump's policies, particularly trade policy. And also we are very much interested in U.S. Fed's monetary policy under new leadership. And so Professor Feldstein will, I'm sure, will share his very, very valuable insights on all of these issues and areas. Because I've spent hours to let you, again, remind you all it's a very successful career, but I don't think I need to do that at this point. So with no further ado, I would like to invite my good friend, Professor Feldstein. Please join me in thanking you.
Well, it is a great pleasure to be back here in Seoul and to see my long-standing friend Ilsa Kang. It's become an annual ritual for me to come here to these breakfasts, and so I welcome the opportunity to talk about what is happening in the United States now, because what is happening in the U.S. is important not only to us, but because of its impact here in Korea and more generally on the global economy. Let me summarize my views about the state of the U.S. economy very, very succinctly. I would say the U.S. economy is currently in excellent shape, better so than even last year, but it is also very fragile, more fragile than last year. So when I look ahead over the next year or 2 years, I worry that the fragile state of the economy could lead to a downturn, and a downturn that would be difficult to recover from in the usual way. So let me talk about all of that and then say some things about my perception of the trade policy of the current U.S. administration. So I start with the good news. The good news about how excellent the condition is of the U.S. economy. Perhaps the best measure is what's happening in employment markets. Unemployment has fallen to 4.1%, and that for the U.S. economy is really very, very unusual. I wouldn't have believed a year ago that we could get so low to 4.1%, and for college graduates now, the unemployment rate is just 2.3%. So we have a very tight labor market, and that tight labor market is inducing people who have dropped out, who have not been looking for work, to start looking for work. So in the last month, we saw an increase in the number of people in the labor force of more than 300,000. Very surprisingly large number. So very, very strong labor market. Wages are rising. They're rising according to the official numbers at 2.9%. Since inflation is about 2%, that means we're getting a small increase in real wages. But I think those numbers understate what is really happening to wages. Why understate? Because when every company I talk to in the U.S. says the same thing. It is very hard to get workers. It is very hard to keep the workers that we have. So they're paying bonuses, sign-up bonuses, retention bonuses, more fringe benefits, and none of those things show up in the monthly wage numbers. So I think the actual increase in real wages is greater than the numbers, the 2.9% that I mentioned. American households are also enjoying substantial increases in wealth. Of course, the stock market is up dramatically, and share ownership in the United States is very widespread, both direct share ownership and share ownership through retirement accounts, so-called 401k accounts. So people are feeling good about that. But in addition to that, the main asset for the majority of American households is their home. We are a home-owning society, and house prices have been rising significantly, up 6.4% in the last year. So with this combination of low inflation, rising wages, tight labor markets, and increases in wealth, it's not surprising that American households are feeling very good. And we see that in the official survey data. The Michigan Survey of Consumer Sentiment tells us that it's at a 14-year peak in terms of the optimism of American households. So that's why I say the economy is in very good shape at the moment. Looking ahead over the coming decade, one of the major impacts of the government policies on the economy over the coming decade is the tax change that was enacted at the end of last year. The tax bill really had two separate parts. There was a broad tax cut for individuals, but the more important part was the corporate part. And the corporate part provides very strong incentives for capital accumulation and growth. Let me explain. There were three aspects of the corporate tax change. First, a reduction in the corporate tax rate. Second, a change in the tax treatment of foreign earnings of U.S. subsidiaries. And third, a move to allow expensing, immediate write-offs for investment. So before last year's tax bill, the tax rate in the United States was the highest among all the industrial countries. The corporate tax rate was 35%, and it has now fallen to 21%. 21% isn't the lowest rate among industrial countries, but it's certainly well below the average of the OECD countries. So a very big drop. Second was the change in the tax treatment of the profits of the subsidiaries, the foreign subsidiaries of U.S. companies. Until the change last year, the U.S. tax system was unique in how badly it treated the foreign subsidiaries of U.S. companies. If an American company had a subsidiary in another country, once that subsidiary had paid the local taxes on its profits, it could do anything it wanted with those profits except bring them back to the United States. If it wanted to bring them back to the United States, it had to pay the full U.S. corporate tax on those profits, 35%, with a credit, of course, for what they've already paid in the place where those profits were earned. So companies didn't bring them back. The penalty was too great, and instead they accumulated profits abroad. About $3 trillion has accumulated outside the U.S. from the profits of the subsidiaries of U.S. companies. About half of that is in financial form, and half of it is in real investments, American-owned companies around the world. We've now changed the rules and brought the U.S. law in line with the practices of essentially every other country. We have moved to what is called a territorial system. That means that profits, once they have paid the local tax wherever those profits are earned, can be repatriated to the United States without any additional tax. So it's a very big change in the incentive to bring profits back to the United States. And in addition to that, the funds that have accumulated, the $3 trillion that has accumulated abroad, are now going to be subject to a one-time tax, and then they're free to be brought home. So when I put all that together, I say, what's going to happen to capital accumulation in the United States, not just next year, but over the coming decade, with a much lower tax rate in the U.S., and with the freedom to repatriate profits earned abroad? I think we will see a substantial shift in capital to the U.S. corporate sector. Some of this will come from repatriation of the profits that have been earned in the past abroad. Some of it will come from the repatriation of newly earned profits. Some of it will come from foreign companies who will find it attractive, advantageous to expand their activities in the United States, to invest in the United States, because the tax rate in the U.S. is now lower than in their home country. And some of the capital accumulation increase will reflect the fact that American companies are no longer given an incentive to expand abroad, so they will keep those funds at home and expand at home. When I put all that together, I think that over the next decade we will see a very large increase in the capital stock of the corporate sector. That will raise GDP, that will raise productivity, and that will raise real wages. So again, very good news for the outlook for the U.S. economy. So that's the second part of what I would say is the very positive situation in the United States. But as I said when I began, it's also a fragile situation. So what's the fragility comes from the fact that asset prices are way out of line with historic experience. Corporate stock prices, equities, bond prices, commercial real estate prices, all of those are substantially higher than one would have expected based on historic experience. The Standard & Poor's 500 index of shares relative to earnings, the price-earnings ratio is now some 70%, 70% higher than the historic average. So way out of line with historic experience. And that has occurred because we've had a decade of exceptionally low interest rates. The Federal Reserve responded to the downturn in 2007 and 2008 by cutting the overnight rate, the federal funds rate, to just 15 basis points. And it kept it there until just a couple of years ago, and has now gradually started to raise that interest rate. But even today, our short-term interest rate is only about 1.25%. By the end of the year, it'll probably be 2%. But that means that today, the real Fed funds rate is negative. And by the end of the year, it'll probably be about 0. That's not right for an economy that has overpriced financial assets. It's not right for an economy that has an exceptionally low unemployment rate. They should have started, in my judgment, and I probably said this at some of these breakfasts a few years ago, they should have started raising short-term interest rates perhaps 3 years ago, so that the froth, the excess pricing of equity prices, the excess pricing of bonds would not be in the situation that we're in today. But looking ahead, I think we can expect to see interest rates rising. Not just the short rate that the Federal Reserve controls directly and has explicitly said they will raise at each meeting this year and on into the future. So not just the short rate, but also the long-term rate. The long-term rate will rise because of the tightening at the short end and the expectation that those short-term interest rates will continue to rise in the future. The long rates will rise also because of increasing inflation. I think as we see inflation becoming more obvious, we'll see long rates being pushed up to compensate savers and investors for the erosion that comes from inflation. And third, because of the fiscal deficit. So we now have a very large, to me, a very worryingly large fiscal deficit. If you go back 10 years, the debt to GDP ratio in the United States was around 35%. And it had been at that number for quite a while, 35%. Over the past decade, it has doubled. So today we're looking at a debt to GDP ratio of 75%. But looking ahead, even before the recent tax bill, the projections were that the debt to GDP ratio would rise to about 95% by the end of the decade. And now with the recent tax cuts and the increases in defense and non-defense discretionary spending, we're heading to about 100% by the end of the decade. And even that assumes that there will be no further cuts in taxes, no further increases in spending, and I think both of those, from a fiscal point of view, are too optimistic. So we have a very serious debt problem, very serious deficit problem. Our annual deficits, which have been about 3% of GDP, are now going to be about 5%. So that means next year the government will have to borrow about $1 trillion. And moving toward the end of the decade, that trillion will grow to $1.5 trillion annual deficits. So that's going to push up long-term interest rates more. Well, with interest rates rising, with long-term interest rates rising and short-term interest rates rising, I think investors will move away from these overpriced assets. They will want to shorten the maturity of their bonds, but in particular, they will want to move out of equities, reduce their equity position. So what happens if the currently overpriced equities return to normal? So instead of being 70% above the historic norm, it simply returned to the historic norm. That would generate a loss of household wealth of about $10 trillion. That's a lot of money even for a big economy like the United States. We now have a GDP of $20 trillion. So just a normalization of equity prices back to the historic price earnings ratio would cause a loss of some $10 trillion in household wealth. That in turn would generate a reduction in consumer spending of about 2% of GDP. And that means we would be pushed into a modest recession. We've been expanding for 9 years, so a recession coming along wouldn't be surprising. And I think the most likely reason for it in the next few years would be a collapse, a decline, a substantial decline in equity prices. Usually when we have a downturn in the economy, the Fed responds by cutting interest rates substantially. Last time when the economy turned down, the Fed cut interest rates by 5 percentage points. But they can't do that now. So with the interest rate that the Fed controls being only a little over 1%, 2% by the end of this year, they can't have a really substantial reduction in the short-term interest rates and the real short-term interest rates. So I worry that we will not have the usual Fed policy to turn around a mild economic downturn. So I think we will have to look to fiscal policy. We will have to look to the policy of the taxes or spending. One of the areas of spending that's been discussed a lot is increased infrastructure investment, but there are no plans. And I think it would be good if the government were to develop plans so that when the economy turns down, they will be able to trigger those plans and stimulate the economy. Similarly, one of the features of the personal tax changes is that they are all due to expire, to end in 2025. So I think if the economy turns down, they could say, well, we will extend that. We will make them permanent, or we will extend them for another 5 or 10 years. And that will boost consumer confidence about their future incomes. But it's a difficult situation, and it's not clear how easy or how fast we would recover from the next downturn. Let me conclude by saying something about the trade policies of the current administration. When I say the current administration, you have to realize, of course, that policy is not just made by the administration, it's made also by the Congress. So what the president wants, he doesn't necessarily get. He has to get congressional support, legislative support for most forms of trade policy change. Within the administration, there are certainly people who want to raise taxes substantially, particularly on steel. The special trade representative and his colleague Peter Navarro have been in favor of doing that. But I think the real issue driving trade policy now is very different. It's not about our imports of steel. It's not about our imports of aluminum. It is about our relationship with China in technology. So I think that we will see this evolve into something focused on China, exempting our friends like Korea, like the NATO countries, and focusing on China as a way of trying to persuade the Chinese government to change the policies with respect to technology transfer. Let me remind you that a few years ago, back in before 2013, the U.S. kept saying to the Chinese, we know you are stealing technology from American companies through cyber. You're invading the computer networks of American companies and stealing technology. And the Chinese, certainly the ones that I met with, said, no, we're not doing that. It's not true. So one of two things were possible. Either they didn't know, or they were lying. I think in retrospect, most of them didn't know. This was not a widely advertised policy on the part of the Chinese government. But finally, in desperation, when President Obama met with President Xi in California in 2013, the United States disclosed what we had learned through our own internet espionage of what the Chinese were doing. And President Obama was able to say to President Xi, look, here's the evidence. The PLA, the People's Liberation Army, are using their cyber technology to steal commercial technology from U.S. firms and turn it over. And so President Xi had to agree that, yes, we found the evidence, they were doing it. And so the agreement that came out of that meeting stated that going forward, the Chinese government would no longer support or encourage or allow other government agencies within China to do that kind of cyber stealing. And while I can't be sure about how effective that agreement was, my sense is it was quite effective. And so we're not seeing that kind of cyber theft of technology. But technology transfer has taken a new form. Now American companies going to China and wanting to invest and sell and expand in China are told that as a condition of doing that, they have to share their technology with the Chinese firms. So if I wanted to set up a chain of donut stores, I would first have to teach the Chinese how to make these very good donuts. And by the time I had opened my stores, the Chinese competition would already have been making my very good donuts and taking their share of the market. So American companies are very unhappy about that. Very unhappy that not just in the donut world, but in general, American companies are forced to do it. And when I say that to my Chinese friends, they say, no, 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 that's all very voluntary. American companies are choosing to give up technology in order to get access. Well, that just doesn't seem to us as fair. And so I think that's the purpose of this current round of trade policies. I think we will see a development of a large number of policies aimed at China. Chinese investment in the U.S., Chinese sales to the U.S., with the understanding that this is a bargaining game and that if they make a change in the technology transfer policies, the U.S. will pull back from that. So let me stop there and see what questions. I know I always enjoy the questions at these breakfasts, and I'm always grateful to Citadel for bringing me here to Seoul and giving me this opportunity to see my old friend Ilsa Kang and to meet with all of you. So floor is open, and I look forward to your questions.
Well, thank you very much. There's a typical Professor Martin Feldstein. It's a very short time, very succinct, but it has everything. You want to know about the U.S. economy and what's going on, in particularly in the U.S. government and U.S. branch. If you go back to some of our publications, on what Professor Feldstein said at this very forum, you will be surprised to see that how accurate he was in foreseeing the future. He has been very, very consistent about this monetary policy and fiscal deficit all along. But in any case, with this, since we have to let him go exactly at 9 o'clock. So if you have any questions or comments, please have Professor An and Dr. Kim later. Okay. Okay, and Dr. Lee.
Professor Martin Feldstein, nice to meet you here again after seeing you at the China Development Forum when we met together the Prime Minister and Davao. My question is that given the rosy picture of the U.S. economy at this moment, especially on the job creation, which Korea really envies, our youth unemployment now hit the record high. My question is that given that the very rosy economic pictures, how come the President Trump lost the Pennsylvania, the congressional election a few weeks ago, and how you would see the prospect of this midterm election, given the excellent economic record. If President Trump lose in the forthcoming midterm election, maybe he might back off his current trade policy. Just listening to you, he's concerned about the cyber theft of the American technology. But my view is that he's really opposing the global free trading system. So, what is your view if he lose in the midterm election? And Korea is very much concerned about this, and so I would like to hear your view.
Yes, a very good question, and I hope I am right about the evolution of trade policy in the U.S., that it will not lead to a trade war, that it will not be a general attack on the global trade system, but that it will focus down on trying to bargain with the Chinese over technology transfer. The recent election, the by-election in Pennsylvania was really, as I understand it, a matter of the individual candidates. That the Republican candidate was not very attractive in many ways, and the Democratic candidate moved far away from the policies of the Democratic Party and was supportive of the kinds of things that the Republicans generally support. But having said that, there is a real risk that the Republicans will lose the majority in the House of Representatives or even in the Senate in the midterm election. Of course, that doesn't change the presidency. The president has a 4-year term, but it changes the scope for congressional action, for legislative action. But I don't think that there is much on the legislative agenda now. I think that the big issue was the tax bill. That was not so much a creation of the president and the White House as it was of the Congress. The Congress, the Republicans in the Congress had been working on that tax legislation that I described for a number of years. And they now have achieved it. And there's no chance of it being rolled back, because even if there were Democratic majorities in both houses and they voted to change it, to raise the tax rates and so on, the president could still veto it. And there's virtually no chance that they would have enough votes to override a veto. So I think there isn't a lot on the agenda, and therefore the election would be damaging, but wouldn't change the policy going forward.
Okay, Dr. Kim, please.
Dr. Martin, it's awfully good to see you again.
Good to see you again.
Couple of questions. First of all, as you said, U.S. economy is very robust at this point, better than any other the growing economies. And also, the indication as a result of the tax cut is that the capital will be flowing in the United States. Those are the factors which would tend to strengthen the U.S. dollar. Now, you also mentioned the trade policy issue more as a issue with Chinese technology issues. So that is very reassuring. Then why is the current market trend of the dollar index so weak?
So the dollar, of course, you have to say relative to what? So the dollar.
Or other indexes.
Well, but the dollar, the main index that I look at is the dollar euro. That's our major trading partner. And if you go back to 2014, when Mario Draghi decided they had to reduce the value of the euro to make Europe more competitive, to increase economic activity in Europe, at that time the euro-dollar exchange rate was 140. And he drove it down through European Central Bank policy to less than 100. And now it's turned around and it's back halfway. It's around 120. So, and that reflects the fact that although the US is doing well, Europe is strengthening, and the European interest rates are exceptionally low still. I mean, the German 10-year bond is 50 basis points. Even the Italian 10-year bond, with all of their political and economic problems, is less than the US rate. So those interest rates are rising, and that reduces the relative attractiveness of moving money to the United States. So I think of the exchange rate as reflecting what is happening in these other countries, as well as what is happening in the US. And what is happening there is fortunately very good for them. And the US doesn't have an exchange rate policy. The US doesn't intervene in the foreign exchange market. We don't change monetary policy to move the dollar exchange rate. We leave it to the market. And I think these market forces are causing the dollar to decline relative to the increasing level of the euro and other countries.
Yes, Dr. Lee.
Thank you, Professor Feldstein. Your presentation is always very easy to understand. You are entertaining the audience.
Excellent.
Well, I don't try to entertain. I've never been very good at telling jokes, so you just get the facts.
My question is about Fed's interest rate hikes this year. You said that you argued for the earlier interest rate hikes. And also you said that the asset price will either collapse or substantially decline. And also you are expecting the downturn of the US economy. Then the common sense dictates that the Fed, in this situation, the Fed needs to be very conservative in raising interest rate. But they say that they will raise it either 3 times this year or even 4 times this year. Do you agree or do you disagree with this ongoing policy of Fed?
Well, I think as a prediction, what you said is correct. The Fed will raise short-term rates 3 or 4 times. I think they could surprise us all by saying we don't have to do it in 25 basis point units. We could do 3 increases of 35 basis points. But in any case, the question is this a good thing given the potential weakness? I think the fact is they should have started a few years ago. You can't roll back the clock, so they have to get interest rates to a level that protects us and that also puts them in a position in the future of being able to deal with an economic downturn. So I think what they're doing is right. I just wish they had started a few years ago.
Okay, now just 2. Dunkirk and Mr. Kwan, and we have to let Professor
Rather
go.
narrowly confined question. I wonder if you could comment on the phenomenon of cyber currencies in the U.S. and worldwide, and also in Korea, which has a somewhat different approach, different from that of the U.S. Thank you.
I can't. I don't understand it. And I don't try. So I hope it all goes away, because I think the cyber currencies have been a source of mischief and are used for bad purposes. And so I have not gone beyond trying to understand it at that level.
Okay.
Thank you very much. As you said, the U.S. economy is almost a full employment level. Therefore, the more you increase spending by asking companies bring back their repatriation accumulated earnings abroad, or asking Korean companies, other companies to invest in the USA, and then trying to spend more money for infrastructure or military spending by issuing bonds, that means aggregate demand will go up. That means you need to import more goods, which is quite cheaper than in the States. Then you will increase trade deficit. Then Mr. Trump will give more pressure. Asian countries, Germany, you need to import more goods or reduce export. So I'm afraid Mr. Trump is breaking down all the system, free trade system, which Korea owed a lot during our fast economic growth. And he's trying to ask us to change our KOROS FTA and then levy taxes and tariffs about steel. So what is your advice to Korea, how to overcome this issue, how Korea can make Mr. Trump happy?
I don't know how to make Mr. Trump happy. I do think that in general, one should watch what they do rather than what they say. That Mr. Trump makes very strong statements, outrageous statements. When he was elected, he said, we're not going to defend South Korea. You're on your own. Then the first thing that General Mattis, the Secretary of Defense, did was to come to Korea before he went anyplace else, and he said, don't worry, we will continue to defend South Korea. The president said, NATO? Well, it's a historic relic, we don't need NATO. Then he went to Europe, made a speech, and he said, of course, NATO is very important for global defense, and of course we stick with the Article 5 commitments. So the president is a speechmaker. is a tweeter, and one shouldn't confuse that with policy. So when I look at the policies until now, they've been quite good. We got a very good tax bill. Maybe this negotiation with North Korea will actually achieve something, putting tremendous pressure. But think about how President Trump has dealt with President Kim. He insults him, he threatens him, he puts terrible pressure on him. So that's not a normal way of behaving for a politician. But this is not a normal politician. So I have to hope that his strategy will be successful. Thank you.
Well, thank you very much, Mari, for spending this very valuable time with us this morning. And as I said, less than an hour's time, we really gained so much from your insights. And fortunately, the bottom line is quite the optimism. Of course, we have to be very careful about particular financial side. But U.S.-Korea trade relationship, and we just hope that things will come out right. And most important thing is the reassurance and Korea-U.S. alliance. As I fully agree with Professor Feldstein on this point, Secretary Mattis visited Korea, and he went to Pyeongtaek, U.S. base, and he was very impressed. And so he reassured, I'm very sure that President Trump and his team about the importance of the Korea-US alliance again, and with the geopolitical developments in this region, I think U.S.-Korea alliance will be strong. As long as U.S.-Korea alliance is strong, I'm sure we can avoid the North Korean disaster, and we can do well on economic side. That's what we've been doing the last half a century. Well, with this, we have to send Professor Feldstein, and we're looking forward to next March for your return with Citadel. I appreciate very much Citadel. You always bring Professor Feldstein. Otherwise, we're very difficult to get in here. Okay, with this, please join me in thanking.
Thank you very much.
Thank you.